You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping our listeners in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Fortra Law, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending. They're eager to share their years of wisdom and best practices for lenders, brokers, borrowers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortralaw.com, to learn more about how we can help you scale. Check out the episode summary below for other valuable resources. Hi everyone, Kevin Kim here, your favorite private lending attorney and podcast host. Welcome to Lender Lounge with Kevin Kim. As you know, we've rebranded to Fortra Law. Very exciting. This video or podcast you're about to enjoy was recorded prior to our rebrand. Any reference to Jurassic LLP is really meant to reference our new brand, Fortra Law. Please enjoy this episode, and thank you for listening. Hey guys, welcome to another episode of Lender Lounge with Kevin Kim. Today we are at the Jurassic headquarters at 20 Pacifica in Irvine. We are shooting here in person. I like to do these with folks who are local to us. If we can do them in person, we'll do them in person, not in the computer. Today, we've been trying to get this guy on the show for a little while now. Thank you for coming, Charlie.
Thank you for having me.
Please introduce yourself to our audience, and we'll get started.
Yeah. Well, one huge honor to be on this show and listen to it and watch it. I guess quick background: I'm president of Fidelity Bridge Holdings, or Fidelity Bridge Loans. This is sort of my first foray on the principal side. My background in this space, I was kind of dedicated to it when I was at Wells Fargo in the investment banking group, where I was for the last 13 years. Spent 25 years in investment banking and came over, joined up with two great partners, David Frosch and Adam Mickelson, who were actually clients in my old days. And when I left, they asked me to join, and off we are.
Yeah, it's interesting because for us, Fidelity has kind of been one of our older relationships. I mean, when I joined Jurassic, it was already on the client roster.
Yeah.
There's a couple Fidelities out there, but this is Fidelity Bridge Loans.
Yeah.
Not to be confused with the other Fidelities.
Exactly.
You guys here in Orange County. Give the audience a little bit more about who you guys are, what you guys do.
Sure.
Yeah.
Yeah. Well, we really focus on our bridge loans for small balance commercial. And by small balance commercial, most of our portfolio, about half our portfolio, is in multifamily, as well as single family residential for investor. So, rental, et cetera. Right. But we'll also do industrial, retail, and other small balance commercial. Small balance, our average deal size is less than 10 million, but we can do up to 20 million.
Right.
And we kind of step in where the traditional sources, whether that's agency or a bank, for whatever reason, can't provide that loan. We're focused on kind of light construction and rehab or other special situations where there's a need, but there's a very clear path to either a takeout and occasionally a sale of the property. Mm-hmm. But in my old days in the investment banking world, I was really focused around M&A and selling a lot of the residential bridge lenders, and residential really meant single family residential. Right. So most of the ones that are in private equity hands now, my old group handled that sale or were part of the capital raising.
Right. And that's why everyone knows Charlie, actually. Right? Yeah, everyone knows. And when you joined Fidelity, we're like, wait, he's coming. He's joining the sponsor side. Yeah. That was very cool, by the way. It's very interesting to see. We never see that entry directly, right? Now, Fidelity's been around for a long time.
Yep.
30 years?
Yeah, 30 years.
Right.
Most of it as a mortgage brokerage side of the business, which we still have. And so we're placing a lot of, permanent loans or have off-balance sheet solutions for that. About 5-6 years ago, we really developed the first fund, and I credit my partners David Frosch and Adam Mickelson for starting that fund. They, as you know, were pioneers in the residential fix and flip lending through Center Street loans, which still is doing great. But we transitioned into this because we felt like there was a scarcity of bridge capital in for whatever reason, for multifamily and other small balance commercial.
Right, and that's the interesting. I remember before you joined, Fidelity was kind of doing a little bit of commercial, doing a little bit of resi, doing a little bit of construction.
Yeah.
It seems that now kind of, well, I guess the winds of the market. You guys
Yeah.
are very much doubled down right now, at least in multifamily and residential.
Yeah.
For the business purpose stuff.
It's about 70% of our portfolio, but we're always opportunistic. I would say, don't count us out for industrial and other and retail, et cetera.
Okay.
But as it happens, we're just getting more demand on the residential side, and that's where we see the kind of bread and butter.
Everyone would echo that sentiment. I mean, I just got back from a commercial show, and it's just all multifamily. That was all anyone could talk about.
Yeah.
I mean, it was weird because a year ago, office was the 4-letter word.
Yeah.
This time around, industrial was also on that list. Industrial is facing a lot of stress right now.
Yeah, we actually just wrote that in our investor letter. I think in industrial, what we're seeing is that there is sort of a bifurcation between the big box and the small box kind of industrial operators. But there, especially with what's going on in the political environment, tariffs. We are, especially in Southern California, where we're based, and a lot of our current loans are. We're watching it really carefully.
Yeah.
So, but we, at the same time, when there's uncertainty, that it also creates some opportunity.
Right. Now, geographic focus, Fidelity is nationwide?
We lend nationwide, but I would say our focus is on the Western U.S.
Right. That's always been the case for a lot of our California guys, is that you're local here. It's easier to do deals kind of west of Texas.
Right.
So I want to touch on you for a second. Okay. So this is a very rare instance. We've only seen this a handful of times in our industry when a person comes from Wall Street as an investment banker and now steps into in the shoes of a direct lender.
Yeah.
There are companies that are like aggregators and I guess you can call them like large institutional wholesale outfits where you have similar profiles.
Yeah.
But you don't see it at the direct to borrower on the street shop.
Yeah.
Now, from your perspective, like your background at Wells, you were on the ground for all the major transactions that we probably have covered on our show.
Yeah.
The MFA transaction, the Pretium transaction, all these big high profile acquisitions in our industry.
Yep.
You could have had your pick. Like I'm sure you had your pick of the industry, where to go.
Yeah. Well, I appreciate that. Yeah. So basically the trajectory was that one, this would not be possible, as I'm seeing now. When you see how the sausage is really made, you realize that a Wall Street background is not, frankly, sufficient without the right partners or the right infrastructure in place.
Right.
So when I stepped in, it was great that one, we had the benefit of a track record, as well as a platform, and then David and Adam, somebody who's been doing this for 15 years.
They've been around for a long time.
Yeah, and seeing the residential side, SFR, multifamily, et cetera. So that's one. But two, as I kind of knew my limits. I think my expertise was in kind of knowing the universe, and then being able to kind of pick off the ones, frankly, that would hire me to sell or acquire a platform like this. I think what we're doing that's a little bit different, and I saw in the trend, is a lot of these private lenders, as you know, grow through private retail investors, family office money, et cetera. And then when a big private equity firm, thanks to the investment bankers like me that are saying, hey, they'll buy you out.
Right.
They flush out the private investors. What we want to do, and it was very important for me to do in leaving that side of the business, is to build something for the future that is sort of permanent. And so we really want to continue growing that retail investor base. We have some great investors that has taken 15 years to cultivate.
Right.
A lot through wealth management firms, a lot through kind of family offices. We grow that, but alongside that, have some institutional partners eventually as well, and to grow that way.
Yeah, it's always been an interesting debate.
Yeah.
Right. Like, is it good for your business to basically have a PE overlord step in and wipe out all the existing discretionary capital and now turn you into basically, are you going to go along the story of Genesis and Anchor and Pretium and Lima? And on the flip side, the debate has been, well, the guys that have rejected those offers are scaling and succeeding, and
Absolutely,
both in multifamily and in residential, we're seeing those guys now doing their own securitizations, doing their volumes have tripled, partnering with institutions on their own, and so it's like it seems to me that this quote unquote idea of an exit may not be fruitful for a private lender. Right.
Yeah,
we're not software companies.
Exactly. And it's interesting because I even in my transition from my old world to this, I talked to a lot of those groups. Like I was responsible for the sale of Genesis, Anchor, et cetera, and talking to those founders. Look, it really worked out for them, and most of them would say they don't regret a thing. Right?
They're back to the table.
But now they're back at the table, and I think for us it's more about the business itself. We don't want to be subject to the whims of, like, for example, the securitization market, or to a group that's kind of in and out. But at the same time, we're kind of lenders and investors kind of at the same time. And we want to do deals that are prudent.
Right. Well, that goes to the permanence, right?
Yeah, and that requires sort of a permanent capital base.
Right. Because that's the funny thing, is that a lot of people commonly think that an institutional investor buying you makes it more permanent.
Right.
But reality is that investor needs to retrade it and get off his books.
Exactly.
Right?
Exactly. Yeah.
Our industry hasn't been around long enough to have seen those rotations.
Yeah.
I think we just saw it with Genesis.
Yep.
So, but the Genesis had gotten so big, had kind of become so detached from the industry that it kind of lost touch with what we're seeing in the marketplace. But when it comes to a lot of the other shops, a lot of our audience doesn't understand that. That company's gonna have to trade hands pretty soon.
Exactly. Yeah.
So that's not necessarily great for the business.
Correct. Yeah. And I think the thing that has morphed, at least that we're seeing, now that I'm on this side of the table, is that there's two types of capital. One is those types of transactions where private equity is in, and then in the moment they're in 3 to 5 years, they need to figure out an exit plan. Right. And therefore, if you're the platform itself, you kind of have a ticking time bomb. But what is starting to happen that didn't exist, call it 10 years ago, are creative deals, because really these private equity firms and the sources of capital want an engine that can originate, underwrite risk. And so if you say, and in fact, one of our prerequisites is that, we want to be doing this in 30 years or 50 years, right? And so that capital can come in, if it's not your sole source of that, then I think you can continue to build, and you can also provide either recap or other opportunities for them to either stay in, or if it pulls out, it doesn't matter, because there's other capital to replace it.
So let me try to distill this. So what I'm hearing from you is that there's this shift in philosophy, even at the institutional levels. Instead of becoming a buyer of companies, instead of owning these guys, perhaps that it's more creative for us to just fill the portfolio with good loans.
Exactly. Yeah.
And do what we will with that.
Right.
So we don't have any sponsor risk. We don't have any personnel issues to replace. Because that's what I've noticed is I deal with people most of my days, and it's always the question where you always see, like, that guy left that shop. How has he left that shop? He was doing so well.
Yeah.
That doesn't make any sense.
Right.
And PE has their reasons for doing things, but if you're a loan buyer instead, and that's better for the sponsor,
right?
Because now they can retain their independence,
right?
Now, I like that. So for a long time, Fidelity was just direct, institutional partnerships,
correct?
No loan selling,
correct?
Like I've known the partners and the former founders, for a long time, and just kind of traditional California hard money.
Correct.
Right.
Yeah.
And so the transition to now bringing that institutional flavor to the business. Talk about that real quick.
Sure. Yeah. It was something we explored as a result of getting a lot of outreach from those institutions.
You're in California.
You're in California. Private credit, et cetera, is a hot commodity right now. And so they need to find the platforms, again, that have a track record and something to study. we were always very clear that our number one priority are the individual investors that have kind of grown with us, and really making sure that the portfolio is solid on that ground. But the institutions, as they were coming in, we didn't think that there was necessarily like kind of a structure that would make sense and be allowed under the terms that we would want. So we still are exclusively kind of retail investor money, but I think in the pretty near future we'll also bring on some institutional investors that almost have a flavor of being like another LP. As opposed to running.
I mean,
that's
been the golden ticket, it seems, and very few have been able to acquire.
Yes.
The common structure that we see is a JV relationship.
Yep.
'Cause they don't want to commingle with retail investors.
Right.
But we've seen it once, but that's almost an impossibility. But they take an LP position in a JV.
Yeah.
A lot more discretion.
Yeah.
You're given a lot more freedom to run and operate, and they have their mandate.
Yeah. Yeah.
That seems to have been proven by many shops here in Southern California and other parts of the country. In residential, now the question mark is in multifamily and commercial. Mm-hmm. I have yet to see that story been played out.
Yeah.
Especially in small balance commercial.
Yeah, yeah.
I don't know if I know anyone that's really entered into those kinds of relationships.
Yeah, it's interesting because we're not, large by any means. We do about $200-300 million a year, but there's just in general is not a lot of institutional capital, not a lot of platforms that are doing bridge lending on small balance. There's a lot of smaller groups that are syndicating loans, et cetera, and trying to crack that space, but not a lot of scale.
For a little while, there were these life co-backed funds.
Correct.
That fund that came in for a little while.
Yes, that's right.
They've kind of not been around. I haven't seen them as often these days.
And it's interesting because those are the kinds of groups we've that reached out and we're talking to.
They need origination volume.
They need origination volume, and what happens is that they're so large that to have kind of this one desk. From what I hear, it's not that those loans went bad, but the resources that they, kind of had to dedicate to it to move the needle, it didn't happen. So frankly, I think that is one of the sources that are going to be very interesting.
Yeah, I've always wondered why, in small balance commercial especially, why they couldn't learn from our friends in hard money residential. Guys, why isn't there a market to buy these loans?
Sure.
Why isn't there a market to JV?
And yeah.
There were attempts at correspondence. There were attempts at loan buying. I think I saw the Veris program come out.
Yeah.
A few life cos were buying paper.
Yeah.
But a lot of them ended up becoming direct lenders themselves.
Yes. Yeah.
And that's a lot of resource work.
Yeah.
A lot of resource suck. So it sounds like to me what you're saying is that now they're learning their lessons.
Yeah.
And they're realizing, wait a minute, maybe the guys in SFR in multifamily are doing it right.
Yeah, exactly. Okay. I mean, I think it's the age-old question, if you're an endowment, do you try to do it yourself or do you try to find a fund or platform that can do that? It is not easy to originate, but it makes a lot of sense for life insurance companies or asset managers on the back end of it that really understand the space. I mean, who's the biggest lender outside of banks?
Life insurance.
It's life insurance companies. They understand apartment buildings. They like the cash flows from
life
rent,
insurance,
et cetera.
I mean, both the long-term and the short-term product would not be available.
Yeah. I think the nuance is that, for it to fit in the life insurance bucket and to be short duration loans takes a little bit of skill and nuance that it just takes resources to be able to do. And then to find that nugget, it's not every loan. It's, one out of maybe 10 though that could fit.
Right.
And so that's what we're there for.
Did you join Fidelity with that specific mission in mind for the company?
Not necessarily. I think we have been very fluid and opportunistic throughout. But yes, we knew that ultimately we were going to, draw from a larger or broader base of investors and that we were going to grow prudently that way.
Okay. As kind of a newly joined president, you have two partners behind the scenes. The company is now taking on new verticals to expand its footprint. Mm-hmm. The question is now, the way the market is playing out for you guys.
Yeah.
It must be challenging for a group that's been known to kind of, especially here in Orange County and Southern California.
Yeah.
You guys have a reputation for being opportunistic, being open-minded to a lot of types of deals.
Yeah.
But the way the market is shifting, it's almost as if really it's just you do multifamily and resi,
Yeah.
or you do commercial. There's no people, not many shops that do both.
Correct. Yeah.
Right.
Yeah. It's a rarity, but actually that's what we're really seeking, is because ultimately we want to, whether it's even an off-balance sheet solution, we want to have a relationship with the brokers as well as the end borrowers. Because if you think about the end investors, many who own multifamily also own, a shopping center, right? And so we want to kind of find a full stop solution for that. But it's a delicate balance because I don't think we've ever sort of, once we've committed and issued a term sheet, changed our minds.
Right.
And so you have to be very selective, and you have to be out there, doing what you're saying you're doing.
Right. And, as a firm that works in both arenas, I see this phenomenon, and I actually don't agree with it either. I'm like, well, good loans are good loans.
Yeah.
And they're all short term.
Right.
But the challenging issue seems to be that it's more of especially with those with investors.
Yeah.
There's a lot of naysayers in commercial real estate right now.
Yeah.
It's funny because, I think they're going through a truncated version of the woes that residential went through in 08. I mean, they're really struggling out there.
Yeah.
And that begs the question for you guys is like finding good deals in that world. Like, are there good deals to be done? It's really a question mark.
Yeah, I mean, we've been fortunate to be able to find it, but there are times where you have to be very careful.
Very
right
careful,
now, right?
Yeah.
And one thing people say, well, what's your crystal ball on where interest rates are going or where tariffs are going? And we say we never know.
The answer to that question.
Nobody has that answer. And but what we're careful about is not stepping into huge headwinds, and we're okay actually kind of staying on the sidelines for a specific sector for a while. But also when you're in a certain geography and have an expertise, for example, an office, which we don't do a lot of, but we do have some office in the portfolio, and they're great. Why? Because they're all owner occupied office versus
owner-operator's different.
Very different, as you know,
Yeah.
right? And then both in terms of what qualifies for a permanent takeout or the SBA world, et cetera. So when you go in with that mindset, we never of like taking back property, but what's the worst case and what's the situation likely to play out in?
And it's always one of those things where sponsors follow trend. They kind of fall into that.
Yeah.
So on that aspect, being more opportunistic, open-minded, what are you doing specifically on the underwriting side to make sure that you're mitigating that risk? Like you mentioned owner-occupied.
Yeah.
Like if it's office, we only want to do the small stuff.
Yep.
Owner-operator, I'm guessing a lot of medical stuff.
Yeah.
Office condo, that kind of stuff.
Correct, yeah.
But like, are there you mentioned SBA, so what are the kind of the underwriting criteria that you're using to keep yourself out of hot water in that CRE space? Because a lot of our listeners are interested in doing CRE. A lot of folks did CRE for a long time. We're seeing a little bit more energy in that market.
Yeah.
New shops opening up.
Sure, yeah.
So like, give me your thoughts. Like how are you mitigating a lot of your risk? Because it's hard to underwrite these deals.
Absolutely, yeah. And you definitely need, and by the way, when I say this, I credit my team. This is not my world. Real estate actually, in general, was relatively new to me. I'm a capital markets investment banking guy. I know how to raise money, but not necessarily that side of it. But every day, every morning, we meet, the full team meets in daily loan committee to look at deals. So it's not just the three principals. It's the full team with different backgrounds. We're focused on two main things. One is asset coverage and strength of borrower. And again, you can make good money not focused on those variables. But as an example, if you are very comfortable that what the worst case scenario on an asset value is, not what appraisers say or not what you get when they submit a loan request, but what which is why we kind of stay focused in markets that we understand. That's significant kind of margin of safety. The second is on borrower strength. So there are some lenders out there that are saying, oh, you know what, low FICO, we don't care.
Asset-based,
right, right.
Yeah.
And they're exclusive. And again, you can do okay that way. We're trying to avoid trouble, not
So it sounds
work
almost
out
like
trouble.
a bank light type product.
It's a bank light product. But for example, a strong borrower, and even on a light rehab project or something where things go sideways and over budget or something like that, and they need to put in a little bit more equity to now qualify for a permanent loan, a strong borrower can do that. Somebody who's stretched is not necessarily going to be able to do that.
Yeah.
So there's number of kind of backup plans, but those are the two.
Actually, so we mentioned bank light, right? So that's actually been a topic of late, and this kind of bridges into your capital markets background as well.
Yeah.
The role of banks in both, let's put residential to the side, 1 to 4 to the side for a second.
Yeah.
Multifamily and commercial real estate, even the small balance stuff.
Yeah.
And I worked at a Korean bank. I was a loan officer. My job was to find and underwrite small balance commercial construction loans.
Yep.
They don't seem to be lending at all.
No, yeah.
It is completely no longer like we will not originate anymore.
Yeah. Well, the stat is that I think regional banks in particular, but if you included all the banks, they accounted for between 50 to 70% of all these bridge type loans.
Yeah.
Not that long ago, 3-4 years ago, pre-Silicon Valley. And then it just, got devastated.
It was always dwindling.
Yeah. And alternative lenders like us accounted for maybe 15% of the market. Now alternative lenders like us account for 35 to 40%.
I would argue higher if you factor in multifamily.
Sure,
rates.
yeah. It's probably understated, but now, and the regional banks and others have gone from, call it almost 70% down to 30%. And probably
it's more than I thought. Yeah, 30% is still pretty high.
Yeah, they're still out there. I mean, that's who we frankly face. And some say, who's your competition? It's not necessarily others focused because there's so many niches of bridge lending, but it's really a bank sometimes doing what they should. Right, is stepping in for a very strong borrower.
What you're telling me is those are the loans that I used to do. Yeah, right. We used to underwrite the borrower more. We spent 6 months underwriting the borrower.
Exactly. Yeah.
Now, that same analysis, and let's look at residential really quick, because what's fascinating with the banks is that they're still actively involved in a weird way. Like I had a brief discussion with our friends over at CB3, and they were telling me like the banks are still active. They're just active in different ways. Yeah. So banks they're not lending on fix and flip and construction anymore.
Correct, yeah. I think it depends because we're in the market every day dealing with banks, right? Because they're our takeout.
Yeah.
Right.
You need
and so And so it really depends on, what how you see them. Like they're filling that voice. So, a loan that's 12 months for us, 9 months later, a bank kind of steps in and does that takeout. Yeah. Now it's still pretty formulaic, 1.2 or 1.25 DSCR, et cetera. So it's a little bit more check the box.
Okay. But they're focusing on term loans.
I think it's still primarily term loans, and then
1.2 DSCR is a very conservative DSCR product that a bank can and should do.
Exactly. Yeah.
But they're not touching the bridge anymore.
Yeah, I think that's right. Yeah. Okay. It's rare that a bank is
what's funny also is that, for instance, in our industry on the residential side, on 1 to 4 fix and flip construction, they were telling us the banks are actively buying these loans, and that was a shocker. I went to a couple of different capital markets. I was like, wait a minute, you're telling me that Barclays, Citi, and these big banks are buying these loans? I didn't even think that they were buying these loans. It was shocking.
Yeah.
I knew that all the buyers existed and they're, upstream of them. I didn't know that those banks would buy these kinds of loans.
Yeah, I didn't know that, but just in general, there are some asset managers that are saying, that because the RTL space has now been a little bit more, I guess codified.
It's sexy now.
Yeah, it's sexy now. There's probably some loan desks from big banks that are looking at that and saying, hey, we're comfortable with that. Yeah.
Yeah, because it seems to me that if you're trying to sell paper and you have access and you have the ability to tell those stories at that level, that might be more accretive than dealing with your local aggregator.
Correct, yeah.
That's kind of, I want to ask about the capital markets perspectives right now, because it's really, really frustrating, but as a guy that's been doing bridge loans his entire life, like even at the bank, right? It's just construction loans.
Yeah.
I didn't touch term loans.
Yeah.
If you come over here, all my clients are RTL and bridge loans. term lending on the private side has just exploded.
Yes.
We were talking before we started, like the advent of the DSCR product.
Yeah.
In not in that 1 to 4, that's been around for a long time.
Yep.
In
Multifamily, yes.
So are you guys actively?
So
involved in
we
that?
are actively doing that too. That's a new product for us, and probably the new, best new product that we've introduced. And these are DSCR loans exactly like you're talking about. So it's not necessarily SFR 1 to 4. It could be multi. There are certain limits. Right now, most of our focus is on kind of $2.5 million loans and below on that.
Small multifamily
exactly.
deals.
So small,
like sub 10 unit.
Exactly.
Okay.
Yeah. Now we can do larger ones as well, but in terms of the most competitive rates and what we're seeing the most activity, and we're competing and beating banks. So that's an exciting new development.
And that's all. And I've always had trouble with DSCR because pricing never made. It's all correlated to the 10-year.
Yeah, it is. It is very driven by treasuries because it's that market looks at a spread to the treasuries. Yeah.
Now, my question is more on the multifamily side, with rates being what they are and with treasuries, but multifamily now coming back. It's now back. It seems like, and I think it's thanks to this DSCR product.
Yeah.
Because for a long time, everyone was like agency.
Correct. Yeah.
Now we have an alternative to agency, SBA or agency. SBA is dead too.
Yeah.
With DSCR being now available at the private level, is it only really the small stuff, or is it also like, you can do it up to, the big stuff?
One of the biggest areas that we're exploring is the larger stuff.
The 100 unit.
Exactly. More the 100 unit, which are actually, those are the ones that we're looking at the bridge loan opportunities for in general.
Right.
But offering a DSCR product to that, I think there's a huge vacuum there.
But is it offered at the institutional level?
I don't see it ubiquitous yet. It's still tough. It's still primarily at that point it does go to agencies or banks.
Right, it has to go to agency. But that interesting why they haven't created that yet.
Yeah, we scratch our heads as well.
What do you think it'll take for the capital markets to figure that out? Because ultimately it's just a securitization product, right?
Yeah, I think honestly it's going to be different pockets. So like for example, life insurance companies. Figuring out and saying, because right now, they're dipping their toes into it. This is my theory, is that they're dipping their toes into it. And if you were going to allocate $500 million to test the market, you'd rather have a very diversified pool than, a couple $25 million DSCR loans.
Yeah, if you've got $500 million to play with, you don't want giant loans.
Yeah. But it's the natural evolution of that market, however you define it.
Yeah, because there's still a lot of I call that still small balance.
Yeah.
It's not like the massive around company, but those things are all privately owned.
Yeah.
Syndicators and developers and funds all own those things.
Correct.
And, I mean, on the real estate side, the hardest challenge for getting those deals done is takeout.
Yeah.
So a private product makes sense for that. They can solve
100% agree.
That's interesting.
Yeah. And that is one of the things that I think is the benefit for us of including institutional investors in that mix that can kind of accordion into new.
So they haven't really telegraphed any reasons why they're not doing it. Just kind of.
You know what? When we chat with them, they all say, "Yeah, it makes a lot of sense." Right. So
probably one of those things. It's who's going to run into the room first?
Yeah, exactly.
No institution ever wants to be the first one out the door. They want to see someone else do it first.
Yeah. But you're absolutely right. I mean, we used to call it kind of internally, a mini perm type of product.
It is.
But we agree with you. Yeah. And it's actually, telling that somebody like you who traffics
we just came back from a multifamily show. I was like, why isn't there a DSCR product for the 10, 15, $20 million deal?
Yeah. We've been talking about this for 5 years now. Yeah.
And they all say, oh, I should just go to the agency product. Well, the agency product it's too hard to qualify for, and it's too expensive.
Well, I think that's also what's creating the need, because before it used to be pretty easy to just get the agencies, but now it's become really difficult.
Very challenging.
So there's a need. Yeah, totally.
And until they solve that problem, which I don't think it'll happen anytime soon.
I agree. Yeah.
I'd like to ask a little bit more about you.
Okay. Yeah.
Because you have a very interesting background.
Yeah.
So. Did you go to Wells right out of college, or were you always at Wells?
No. So right out of college, I actually was an analyst in Morgan Stanley.
Okay, so you've been in that world.
In that world, yeah. And I was at Morgan Stanley for about 6 years. I've also been in private equity as well. So I kind of hopped around a little bit, but for the most part, it was Morgan Stanley, Citigroup, and then Wells.
And all kind of the iBanking.
All in the iBanking.
So were you always kind of touching this market, or was it?
I was never touching this market, frankly, until I went over to Wells. So I started off as a media telecom M&A banker.
Okay.
Very different. And
Very different, yeah.
And then it eventually morphed into kind of consumer companies. Mm-hmm. And then when I went to Wells, it was actually right when Wells was never in the investment banking world until they acquired Wachovia during the Great Recession. Mm-hmm. And that's when I was hired on to try to build it. So it was almost like a startup within this massive bank.
Right.
And we were chasing opportunities where the Wells commercial bank had relationships. Didn't matter.
Which makes sense.
Which makes sense. And that's when I was actually introduced to this cottage industry. Mm-hmm. And I was scratching my, how are these groups making 11%?
When was this?
This was 2011. So the very first deal.
So you were seeing it in the bad old days when 12 and 4.
Yes.
Hard money lending.
But where mortgage rates were 4%. I was like, how is this delta possible?
Right.
And then it made a lot of sense.
The only national shop was like Genesis.
Well, Genesis was my first deal. So Genesis, when I met them, they were doing $60 million a year. And then
fascinating, right?
And I was so fascinated. We made a call, and it was a lucky rifle shot to Oaktree, who was in my backyard, and I also covered. And it was probably the one group.
Was Oaktree actively involved in real estate?
They were actually trying to do this themselves at first, which is why they realized they needed a platform. So they didn't care what size, but credit to the Genesis team, et cetera. And once that marriage happened, then the other lenders, Anchor was my second deal, and so they came out of the woodworks looking for that same deal.
Well, it didn't feel that way because we were on the ground. I remember I was at APL when the Genesis deal penciled and I got announced, and I was like, "Wait a minute."
Yeah.
Because the Oaktree deal never got publicized.
Right.
It was the Goldman deal, and I was like, Goldman bought Genesis? This doesn't make any sense because the market was so small.
Yeah. Well, what happened was we handled that sale as well. And what happened was the Oaktree moved so quickly on this first deal because they did not want me to shop it.
Right.
And
they wanted a platform.
They wanted it. And they wanted the platform. And it was a structured investment that we had negotiated, but they had warrants in the company. Mm-hmm. And so it went so exceedingly well. They scaled from $60 million a year to $1.2 billion in 2 years.
That's about right. Yeah.
And at that point, the warrants were worth so much, they hired us to then sell it. Mm-hmm. And Goldman, and that was a competitive auction. And Goldman had, I think, kind of like mixed results, and they tried to acquire it, as you may recall, like through their quote commercial bank, and with lower cost of capital. But a commercial bank then is subject to the regulations of a commercial bank, and that's why they had to expedite a sale. And then there was a third transaction.
And that was the fascinating. Everyone talks about we were talking about M&A in our industry. So aggressively and so actively. Right? It's fascinating because you're on the ground floor. And we met other folks that had their hands involved in all these different trades, but they were all happening at the same organization. All the high profile ones. So let me ask you about the Anchor transaction. So M&A in our industry, I've never been a huge believer in it. And then I had to change my tune because Anchor Steve Pollock. He's a legend, right? Dr. Pollock's a legend in our industry, and he's in California. So I was privy to his story early on as a junior associate here. Everyone was like, they're it, right? And then when they brought on Wafra, they're like, oh, now they're really it. And then when they sold to Pretium, that was just like, holy crap. Our industry has arrived. But at the same time, I've always Anchor also they morphed over the years. So it's been a challenging question on my side. I've never known that M&A is that beneficial for our market.
It's funny you say that because Steve Pollock is who I called recently just to check in and say, hey, great. He's doing great. He's actually doing some deals on his own, and he's retired in Florida. But
he's in Florida now.
I
think he'd be in Hawaii for some reason.
One or the other. But he I asked him, do you have any regrets in selling out? And he said, absolutely not. But he said he gets it, in terms of, and we were kind of comparing notes because we ultimately, what our focus is in really kind of growing and keeping the platform forever.
Because you're taking what a lot of folks are independent guys are saying, we don't want an institutional partner.
Yep.
We don't want one.
Yep, exactly. And Steve said that they debated this internally. And that's when I did that Wafra deal. I think ultimately it benefited in the sense that...
I think the Wafra deal benefited them immensely.
Yeah, it benefited them, but I think the industry as well, because it's that led to the intro of RTL into the securitization market, et cetera. You do need a little bit of the institutional and Wall Street money to be able to figure stuff out creatively. Right. Where I think it has hurt is the capital is still subject to the whims of the market. And there are times where securitization sees up for...
It's going to have to.
Yeah, and it will, right? And so what happens... What's the trickle down to the originators, the borrowers, et cetera, in that time?
And that's the thing is I've been preaching to my clients, like they get offers. I'm like, guys, sometimes it's smart to stay independent. You remember how well you were doing during COVID?
Yeah.
That's a sign.
Yeah.
Because the reason why your competition was suffering was because they were 100% reliant on capital markets and they took a dump. They couldn't do anything.
Yeah.
Not their fault.
Right.
Their money's fickle.
Right, exactly.
Your investor money's not. It's smaller.
Yeah.
It's not $5 billion, but it's meaningful.
Yeah.
And it'll last and it'll stick by you.
Right.
You'll live to fight another day.
Right.
Is what I've always had this like challenging issue is like, the market has grown. I mean, I remember when someone told me they were doing $100 million a year in origination, I was like, oh my God.
I know, I remember that too.
So much volume. And then today, you look at the top 10 lenders in the country, they're all doing $1 billion a year.
Yeah.
Or close to it.
Yeah.
And it's just like...
Yeah.
So our industry certainly benefits from all of your efforts and all of the institutional investors' attention. But it begs an interesting question, like from a capital market standpoint. Right now, securitization is all anyone can talk about. 3 years ago, M&A was all everyone could talk about.
Right.
It makes me wonder what's the next thing.
Yeah.
Right?
Yeah, I don't know what the next thing is. I think it'll probably start to stabilize a little bit into different sources. Insurance money in our industry is somewhat new, and it's a nuance because it's also securitization, but it's its own.
They seem to only really like the term stuff right now. I don't see a lot of allocation from Lifeco into like RPL.
Yeah, and I think, without getting into like all the nitty gritty, sort of like securitizations, Lifeco money has to fit into a kind of ratings bucket. And you can do that.
It has to be investment grade.
Yeah, it has to be effectively, but it has to be manufactured investment grade. Right. And so those are the things that, frankly, we're learning. I'm learning.
Well, it's coming around now.
And and it's developed a lot, I think, in the last couple of years. So I think it is just a matter of time.
It's interesting because I just don't know. Lifeco has tried to break in, and that was the big hang up. They couldn't figure out
how to do
the solve on the institutional grade.
Yeah.
But then when the ratings happened, they still didn't jump in. So my question was it because the ratings not high enough? Or is it because the company's not rated? What's the issue? Like, is there, what's the issue on the Lifeco side? Because they've only gone in on the DSCR.
Yeah. I mean, again, I think insurance money is very focused on cash flow, right? And debt coverage.
Hence the DSCR.
And so hence, like, let's say ground up construction, by definition, it's zero cash flow and, negative cash flow. So how do you do that? Yeah. And the answer is there are ways now, to be able to do that. And so that's where things are, I think, evolving.
I hope so. I mean, that might be a much more, because the nice thing about Lifeco is it's much less fickle in the context of once it's locked in, it's locked in. Yeah. Once they figure out how to crack that nut, typically stick around for a while. Yeah. We've noticed that on commercial. Like, they haven't really gone anywhere in commercial. Yeah. They're just having efficiency woes.
Correct.
Right?
Yeah.
They're just trying to figure out how to make that widget better, but like, they're in. Yeah. They like it. They're in. They figured it out. Yeah. I think they're on. I didn't know that they were trying to figure it out on RTL. That's good. That's good news. Now for Fidelity, right? Because the mission is to stay independent. Yep. And integrate some partners. Yep. Tell me more about like kind of your guys' vision for the future when it comes to your partnerships with institutions. Because right now the appetite seems to be they're all looking at residential. Right? They're all just paying attention to residential. Yeah. Commercial's kind of not popular. Multifamily, I don't know what their sentiments are like. So you mentioned earlier that kind of they like the DSCR for multifamily. So are you guys pushing into, like, I would call it, I guess you can call them JVs, or just more like buckets of capital at your discretion to access?
Yeah. I mean, I think what we're exploring are partners that, even if they're institutions or have a long-term vision, and there are groups like that, so we're very selective about who
they want to commit with you for a while.
They want to commit for a while. I think actually the ones that really appreciate us stepping out of the market, we stepped out of the market for a couple months, during like the rapid interest rate increase, which actually benefited us. But not this, hey, you got to put dollars to work type of mentality.
Right.
And actually those that offer a little bit more flexibility in terms of us not changing our game plan or business plan, which is there are some commercial deals that make sense, and there are some residentials that make sense. And what that does is it brands you uniquely as a platform that provides solutions for borrowers, strong borrowers. And because again, if you're real estate investors, many have a mix of that portfolio.
The goal is to bring on someone that's flexible.
Flexible is the right word.
And also much more committed.
Committed to.
Okay.
Yeah.
Okay.
Yeah. That's
for both. That's for both multi, commercial, resi, all three, and then also short-term, long-term.
Correct. Yeah. We don't want to change our plan. And then again, I think the institutional strategy could also help us expand into adjacent markets like the mini perm, et cetera.
Well, I mean, mini perm is. I mean, if you guys can crack that nut, I think the market will benefit from that greatly.
Yeah.
I would like to see that happen personally, just because we've been boxed out of the agency world as a law firm.
We need it. We definitely need it. Yeah.
For more than a decade now, I have been trying to get the law firm approved as an agency law firm. Approved law firm, because it's a fascinating world. It's like a monopoly of law firms approved to do those documents, and it never made any sense to me. And I was like, that's like so un-American.
Yeah. Well, same with lenders. You need to, there are only a handful that are given the license to do it. So.
Right.
Yeah.
It doesn't make any sense.
Yeah.
Right. So now, as a former M&A guy, right, I guess you can call it reformed M&A guy, that must kind of be in the back of your mind constantly.
Well, we get asked, and a lot of people kind of presume that that was my goal
your career
as well.
Before.
Yeah. And look, it's always kind of a partners conversation.
Right.
The good thing is that Dave and Adam and I are always we run by consensus. If one person doesn't share in that vision, then we choose to go with what does.
Right.
But I think honestly, even for all the greatest success stories, Anchor, et cetera, you ask them, if you could have done it independently and had that same kind of end result, would you have kept it independent? They say, of course.
Right.
They just don't think that would be possible. And so for us, it just means kind of growing in a more, prudent manner. But at the same time, we agree there's a window of opportunity. You were saying earlier, like, why wouldn't you grow if you can? You absolutely do.
Well, that's also one of the interesting questions. Like, we've had clients tell us, like, I could be 10 times my size, but if I did, I would also have 10 times more problems.
Yes. Yeah.
So you could also choose to grow in a way that's great for the team.
Yeah.
But not, so that it's bad for the business.
Yeah. Yeah.
But the opportunity is there. So that's kind of a challenging question.
Sure,
as an operator, it's like, now you're faced with that conundrum.
Yeah. Yeah.
I can add the horsepower that I want.
Yep.
And suddenly have the need to be tripling my staff.
Sure. Yeah.
Right.
Yeah.
Tripling my executive team.
Yeah.
Whatever.
Yeah.
And are you guys juggling with that at all?
We juggle with that a little bit. I mean, it's always a balance.
Right.
Yeah.
Because to maintain that independence. Means that you're going to have to accept the reality of, okay, we're not going to scale as hard and fast as
you can.
You can. Yeah. Because if someone buys in, an institution owns you.
Yeah.
A different conversation.
Yeah, we're always like kind of looking for that happy middle. Mm-hmm. And again, I think you just have to stay true to what your vision and plan is. Maybe it's the right call, maybe it's the wrong call, but in general, I think there's a real opportunity to just.
But at the same time, like small transactions, not big transactions. So in SFR. We had Mike Hoffman on the show from Longhorn. He acquired Skybeam.
Yep.
I just saw him a few days ago.
Yep.
Shout out to Mike. We also have seen these small transactions happen where it's not necessarily M&A in the true sense. It's more, okay, this guy he wants to get out.
Yeah.
But someone needs to continue his legacy and fold him in. And that's an interesting way to grow the book.
That's actually interesting you say that, because we've been approached now by many, I wouldn't say competitors, but other bridge lenders, especially from my old world, because I
that's what I'm saying. Because you have an M&A background, they must be thinking they must assume he's going to grow by acquisition.
Yeah, it's harder to do than people think. There is an opportunity like the Oaktree Genesis deal or the Pretium Anchor deal. They can work out, but you need to have a vision of X billions in scale for the math to work.
That,
for that.
But for these
smaller,
it's interesting.
I think what is happening, and I always say this, is if you're a really small operator, your value is probably, 0 to whatever value, somebody thinks.
What's your book value, really?
Yeah.
It's hard to ascertain.
Yeah, you can't use
your value
the same
is you.
metrics. Yes, it's really kind of more of a talent acquisition or the platform acquisition. However, that said, I think it takes a lot of diligence to figure out whether that platform, there's real value in that platform.
Right.
Either underwriting guidelines, managing risk, team, as opposed to replicating it or doing it yourself.
Correct.
Right?
Well, it seems to me at the small level, it's more I like their book.
Yeah.
I like their business.
Yeah.
They've got a good book of business.
Yeah.
They've got a decent amount of capital.
Yeah.
They look good if we integrated them into our business, it wouldn't be disruptive.
Yeah. Yeah.
More of that perspective,
Yeah.
as opposed to there's some valuation calculation, future sale methodology here.
Yeah.
And it's grow through acquisition, but grow almost they basically do the same thing we do.
Right.
Let's swallow them.
And it's also really hard, and this is always the case, it's really hard when you're acquiring a platform that has a loan book that pays off entirely in a year.
Yeah. Well, that's the thing is book of business, right? It's like law firms. You have to have a repeating.
Sure, yeah. And even with, if you do it based on book value, et cetera, you got to assume that capital can be redeployed.
Oh, yeah.
And that the market.
What's the book of business of the LOs, the principals, and are they going to stay on?
So it ultimately comes back to the talent.
Correct.
Talent
I agree.
platform.
I agree. I always tell small operators, you can't think of yourself as some kind of big tech platform that's going to get that 8x multiple. You are a law firm, you are an accountancy, you are a brokerage shop. That's kind of how you should think about yourself.
Yeah.
And that seems to temper their expectations a little bit.
Yeah.
But I've actually seen some success in doing that, where we had a small deal happen on the East Coast. We had a relatively small deal happen with Mike Hoffman. It was but it's worked out. Yeah. Because the seller was motivated to get out and write off into the sunset eventually.
There are there's a lot of need right now, especially even with aging owners,
sponsors, they need to retire.
Owners. Yeah, they need to do that. And so they're trying to figure out. So I think the opportunities will be there whether we pursue that path. Unlikely, probably.
It's hard to sell those companies and buy those companies. So if it's especially if their business is in the Stone Age. Yeah, it's tough. Yeah. Now let's kind of look into you guys are now doing a lot of different things. Mm-hmm. Your team is growing too, right? So I think you guys hired one of my friends from the banking world. Mm-hmm. He was one of my favorite LOs in the lender finance world. You brought Dylan on. Yep. And you're bringing on more talent, it looks like. We are. That's something we are looking to do, both geographically as well as, so we're looking, for example, in the Texas market, in the Pacific Northwest market. Tough markets.
They're tough, but again, that's where we see the opportunity, potentially. And so we're always kind of looking to add on. The beauty of our business, though, is that in order, especially when I always looked at it as it takes the same number of people in the infrastructure to do $100 million a year as it does to do almost $1 billion a year. Yeah. As long as you have the right people, it's how you originate, et cetera. That's where you need to kind of expand. The back office definitely can be done that way. I think the challenging issue is the front office, where just if you're doing SFR, you're dealing with really the number of loans. Yes. The number of files to process is significant. Exactly. Right? Yeah. So that's one of the reasons we like our area, even though it's small balance,
Right.
is still typically much larger than a fix and flip loan.
Yeah, you're not doing a $80,000 bridge loan.
Exactly.
Yeah. Now you said Texas and the Pacific Northwest. Opportunity-wise, I have you expand there because Texas has become saturated.
It's really tough.
It is.
Yeah.
No, Seattle not so much, but Texas is quite saturated.
Yeah.
And there's so many lenders now.
Yes.
I mean, the joke is that once, especially in SFR, once they figured it out, everyone ran into it. And like from a rate standpoint, Texas is worse than California.
Yeah.
At least in SFR. In RTL, I think Orange County, the average rate is like 20 basis points higher than Austin, Texas.
Yeah.
And so it's like, how did we get here, folks? Right.
Yeah.
So is it mostly not residential stuff that you're looking at?
It's rarely residential, unless you include multifamily as residential.
That's the hard part. Yeah, it's not. Well, that's what I meant.
But they're all like a lot of kind of nuances. For example, like the tax abatement, situations in Texas. We just did a deal like that, and then other you got to know the local markets and then be able to assess it. But sometimes the math is way better than it is here. I mean, you'll have some things that, right out of the box have 1.1 DSCR, but doesn't qualify yet. And it's, under rehab. And you're just like, okay, well, why? And no one's really able to do that. So we're really, but sometimes there's a reason why, and that's where we're kind of going after.
I mean, it's a huge need. And multifamily in Texas has grown leaps and bounds.
Yeah.
There's so many new developments.
Yeah.
And they're all small. A lot of them are small. And a lot of them are, I just got back from the multifamily show. Dylan was there. And the stress on the financing side was real.
Yeah.
And the lenders that showed up were so happy because this is great.
Yeah.
There's only 4 of you guys in the room. They were so happy because everyone in that room they're all small balance, middle market owner operator builder types.
Yeah.
They were all stressed out.
Yeah.
So they all needed better opportunity on finance, especially on the term stuff.
Sure. Yeah.
And I brought up DSCR on my panel. Everyone's eyes lit up. They're like, "Oh, I know I could do that."
Yeah.
So that's great.
Yeah.
That's great. You guys are offering that in Texas. I don't think a lot of folks have figured out the multifamily just yet.
Yeah.
Now, with multifamily, you guys don't do the construction stuff though, right?
So we're likely also with another partner to introduce something that on ground up construction.
Okay.
Yeah, which is and frankly on the larger ground up construction for multifamily.
And build to rent's always been a very popular topic.
And build to rent as well. Although there are more bridge lenders kind of around
more
that
bridge lenders
space.
in that world.
Yeah. So we are, but I would say in multifamily, for our kind of bridge loan, our core product will be stuff that is very light rehab. It's just hard to monitor construction loans and draws, things like that. And so that's why. But there is an opportunity there.
And touching on commercial again, I'd like to find out kind of your view on when you think it's gonna, because people are talking that it's getting better, right? Like last year was better than the year before that, from a sentiment standpoint, from a flow standpoint.
Yeah.
I'm hoping by this September when we go back to CMBA, it's going to be a little bit better. Every year it gets a little bit better. It'll be exciting again.
Yeah.
Do you think it's going to come back soon? I mean, it's tricky. I just don't see it.
I don't know if, quote, it'll come back.
Right.
Because I think commercial just requires a lot more of an understanding of the story and the situation.
It's a lot more custom.
Yeah. And so... And it changes. Like, so you're right. Like office was a 4-letter word, and it's still probably is, but it's kind of coming out now. There's some great
people have found the niches.
Yeah, exactly. And I'm talking more to the office equity, players who are buying at a 9% cap rate.
Yeah.
Right. And they're doing it all cash.
Right.
I know somebody who just closed a $70 million deal in Calabasas, all cash.
Right.
But it's
but the discount on the property must have been immense.
Exactly. And it's like, and it doesn't matter that it's 100% leased. No one cares, right? So hence there's probably opportunity. But as a lender, it's still tough to, most of the deals you're getting on are there's a reason why.
Has it been at least a moderate increase in volume for you guys, or like since last year to this year?
Yeah. Oh, yeah. In commercial in general.
Commercial, yeah.
Yeah. For us, there has been an increase for sure. But again, like industrial warehouses, which we really liked, and it was a great.
It was the darling of the industry for a solid 5 years.
Yeah, and that's really been, probably the new office, at least for the interim. So you got to tread really carefully, but those opportunities are there.
Right.
Yeah.
And capital is still interested.
Yeah, capital is still interested. When we underwrite a loan, I mean, part of it is like we need to be very confident in the permanent takeout too. So capital is there. We by definition for us, like the capital needs to be there on the permanent takeout one way or another. Okay. On the bridge side, you're right. I mean, we're able to. There's a lot more kind of flexibility in what a borrower is willing to accept.
That's good to hear. I mean, we hope that it comes back.
Yeah. I think it will. There's always going to be
because there was a lot of our commercial bridge clients have. I mean, kind of like yourself. Nowadays, all they're doing is multifamily, and now they're doing some residential.
Yeah.
And it's like, but their investors are more like, well, where's the commercial? Where's the commercial? And they said, well, you guys don't want us to take that kind of risk.
Yeah, that's right. That's right.
I just hope they don't jump back into like doing pref equity all over again. So
that got a lot of people into a mess.
Oh yeah,
including some bridge lenders who were allowed to. Yeah, our bridge product is first lien only. As you know, as an investor, we only allow ourselves to do first lien.
Yeah, pref equities. If you don't know what you're doing, it can be quite scary.
Yeah, it is. Yeah, but it can be handled.
So I guess kind of part of the show we're going to talk about future plans, right? Yeah. Vision for 2025, and it's only May. Yeah. So 2025, rest of this year, going into 26. Tell our audience kind of, what you guys gonna be working on. How can they work with you, or how can they find you?
Yeah. Well, I think for us, we want to be, out doing basically, what we've said we've been doing. So we're looking for loans on, to back strong assets, strong borrowers, and generally in the Western U.S. And in addition, I think on the back end, working on some other capital partners, we're likely to to continue to grow that base, as well as our retail fund, which is a huge focus for us. We have a lot of interest now, especially kind of as private credit is so in vogue, and performance has been strong. And so with this whole sentiment, actually, of private market offerings being available for, especially not just ultra high net worth investors, but just regular investors.
With inflation, the accredited investor definition has become a lot less restrictive,
right?
Especially here in California,
right? Yeah. And so we really want to grow that base. So it's the bookend. It's the capital source part of it, as well as finding good borrowers to lend to.
And our listeners, if they are they're originators, so you guys take on all comers. It sounds like residential, multifamily, commercial, small balance, bridge and long term.
That's
great. That's fantastic. And I always love doing these commercial episodes because it takes me back to my banking days. And, I miss talking about commercial.
Blood.
I miss talking about commercial because we don't. It's just
not that many are doing it.
I mean, we just don't see it as often as we like. We miss it. It's from a law firm perspective. It's always been much more attractive from a law firm perspective, and it keeps us busy. It keeps us busier, but also keeps us nimble. Residential is kind of formulaic. So all right. Well, that's all the time we have for this episode of Lender Lounge. Charlie, thanks for coming down.
Thank you for having me.
This was a really fun privilege. Tell the team I said hi.
I will.
And you guys can see Charlie at the what conference is next for you guys?
The next one is probably the real estate one in June in Laguna.
Right.
For family offices. And
the family office show. Yeah. That's a good one. Yeah. So if you guys attended that one, you can grab Charlie and ask him some questions. Thanks for listening, and we'll see you on the next one.
Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortralaw.com, to learn more about how we can help you scale.